Hello everyone, this is the third time I'm attempting to record this video, a few IT issues. I'm going to run through this question 2 of the November 2024 paper quite briefly. If you have had a look at my video, it's video number 42A on adjustments and financial statements. You should be able to follow as I work through this. So let's have a look here. We're given the pre-adjusted trial balance of this whiteboard manufacturer's company. Now, if it's a pre-adjusted trial balance, it will be given to you on the last day of the financial year. 12 months have passed, and you need to calculate the financial result and financial position of the business according to accounting principles. So if you have a look at these balances here in the pre-adjusted trial balance, straight away I can see that this business is using the periodic inventory system. So cost of sales will be calculated using the periodic inventory system because I see the purchaser's account. You need to know the perpetual inventory system, but students have asked me to do this paper, so I'm doing this paper. But the adjustments will be similar whether you're using the perpetual or the periodic inventory system. So it is a good example. So let's have a look here. We're given all these numbers. They don't truly reflect the financial result and position of the business. So we need to do adjustments. So I've moved to the additional information. These are typical adjustments that happen at the end of the financial year. The first one is Mr. Moon and Mr. Start's debtors of ours need to be written off. So the entry would be debit bad debts and credit accounts receivable. These two numbers here, 12,000 and 4,500, affect the balance of bad debts, which is at 75,980. This amount will change. Bad debts will increase by 12,000 and 4,500, and accounts receivable will decrease by those two amounts as well. So that's adjustment number one. The second thing you're given here, the allowance for doubtful debts needs to be adjusted to 10% of accounts receivable. Now, you need to take off the 12,000 and the 4,500 off accounts receivable. There it is, 365,780 minus the 12,000 minus the 4,500 multiplied by 10% is going to give you the new amount for provision for doubtful debts. If you've seen my video 42A, adjustments and financial statements, you will be able to follow what I'm saying, because I take it that you have a certain amount of knowledge before you going through old exam papers. So when you take 10% of the new accounts receivable amount after the bad debts, you're going to get the new amount for provision for doubtful debts, and it is 30 something thousand. You can punch it into your calculator after you've taken off these bad debts off accounts receivable, because it says the allowance for doubtful debts needs to be adjusted to 10% of accounts receivable. Number 3, after conducting the year-end stock take on the 30th of September, the following balances were determined. That inventory closing stock is going to be used in cost of sales. The stationery, if stationery is left over at the end of the year, it's shown as an asset. You're going to debit consumable stores on hand, and you're going to credit stationery. And the stationery amount, there it is, 6,200. You're going to minus the what's left over, then you're going to get the stationery that is used. I'm going to show you the statements in a moment. I'm just running through this additional information to give you tips on how to complete the statement of comprehensive income statement, and the statement of financial position, the balance sheet. So there, at the end of the year, inventory was 157,800, stationery 2,400. Number 4, included in commission income is 50,000 for a contract for a 6-month period. So we are doing the books of this business, and we have collected commission, and in the commission is income received in advance, but we need to determine how much income we have received in advance, and this income that we've received in advance is for a 6-month period, 1st of July 2024. Now the end of our financial year we've seen is September, the end of September. So July, August and September has been earned, but October, November, December hasn't. So 3 out of the 6 months is in the commission income account, and it shouldn't be. So we would debit commission income and we would credit income received in advance, and it's for 3 months, so 50,000 multiplied by 3/6 is 25,000. That needs to be taken out of the commission income. The investment was invested with Whitewall Bank on the 1st of January 2022. They're just telling you when this investment was taken out at the start of each financial year. Interest earned is at 0, so we need to calculate what the interest should be on this investment for the financial period. And if we go and look at this investment, the investment was with Whitewall Bank at 8.5% per annum, which comes of 140,000. The investment taken out was 140,000, and it's at 8.5% per annum. And if you go and check, interest on the investment is at 300. It shouldn't be 300, but at the moment it's showing 300. If you take 8.5% of 140,000, that's what it should be. So I know this year you're going to have to increase that amount to 8.5% of 140,000. I think it's 11,900. So that interest income needs to be increased. It's owing income, debit accrued income, and credit interest on investment to take it to the correct interest earned on the investment for the period. So I'm giving you clues here as how to do this. So I've done number 5. Now it says number 6, no repayments were made on the long-term loan during the financial year. So there's a mortgage loan, it's at 11.5% per annum of 674,980 is going to be our interest expense. And we check, is there a balance for this interest expense? Yes, it's 76,000 what we got on the books at the moment, but is that correct? And I know it's not correct, because if you go and calculate 11.5% of 674,980, you're going to get more than that 76,000, and you need to adjust that account. We'll check out in a moment by how much. Number 7, depreciation still needs to be accounted for. 2% per annum on the straight line method for buildings. So if we go and check here, buildings, there it is, land and buildings, 200,000 was land, so we need the depreciation is 2% on the 1 million, because we don't depreciate land. And then also while we're here, Furniture and fittings, I think the depreciation is 10% on furniture and fittings on the straight line. So it's 10% of 107,600 for the depreciation adjustment. And those are all our adjustments in the additional information. Now they say prepare the statement of comprehensive income for the year ended 30th of September 2024. Number 2, this isn't a complete financial statement for the financial position, balance sheet. They only ask for the equity and liabilities section of the statement of financial position. Now for your exam, you need to know how to complete a statement of comprehensive income and a balance sheet or statement of financial position. The whole document, both of them, the whole document, not just parts of a statement of financial position. Now if we look at the solution here, this is a statement of comprehensive income, and you're drawing it up with the new numbers after the additional information, the adjustments. Now this is a periodic inventory system. If we look here, sales less sales returns is going to give the sales amount of 491,716. Cost of sales is calculated by saying opening inventory plus purchasers plus the purchaser's costs less the purchaser's returns less the closing inventory. This purchaser's cost was carriage inwards, right? They're calling it now purchaser's cost. That there gives you the cost of sales in a periodic inventory system. We will most probably do a perpetual inventory system. So it will be sales less cost of sales is going to give the gross profit. Then we add other income, rent income, bad debts recovered. Now the interest on the investment, the total amount should be 11,900. 300 was in the pre-adjusted trial balance, plus the 11,600 after the adjustment. The interest on the investment is 11,900. Remember to record these amounts in brackets here, because there you can see the mark allocation. The commission income had 25,000 Rand worth of commission that relates to next year. It needed to be taken out to show the correct commission income for the current financial year. We did that adjustment. It was a 6-month commission period, 3 months related to next year. We needed to take half of the 50,000 out. The interest expense, when we calculated the interest on the mortgage loan, should have been 77,623. In the books it was 76,000. We needed to add that 1,623. Stationery was left over. There was 2,400 Rand worth of stationery left over. So the stationery used is the stationery bought, 6,200, minus the stationery that was left over, consumable stores on hand. Bad debts was 70,980. That was the balance on the pre-adjusted trial balance, plus the 2 debtors that were written off. And then there was a provision for doubtful debts, which needed to be increased by 19,928. There's 112,408 for bad debts. Right, salaries didn't change. Depreciation for the year was 2% of $1 million, and then it was 10% for furniture and fittings. Comes to 30,760. So how do we get the net profit for the year? We say sales minus cost of sales gives the gross profit, plus other income less operating expenses gives the net profit for the year. These workings here There was interest on income. 140,000 times by 8.5% is 11,900. It relates to, there we go, interest on investment. There was an investment that earned, I think it was 8.5% per annum. Should be 11,900. Yes, there it is. 11,900. The commission, the income received in advance, was 50,000 times by 3/6, because 3 months was received in advance, is 25,000. Need to take off that 25,000 off the commission income because it relates to next year. The interest expense should be 77,623. 76,000 was in the pre-adjusted trial balance. It should be 77,623. So we need to add another 1,623 to get to the correct expense. There's the depreciation. I've already discussed that on the buildings. 1 million times by 2% is 20,000. And there's the depreciation on the furniture and fittings times by 10% equals 10,760. So that's how we calculate the net profit. Then in the statement of financial position, they asked for the equity and liability section only. Remember, a full statement of financial position will have the assets, non-current and current, plus assets equals owner's equity plus liabilities. They've only asked for the second part. There's the equity. What does equity consist of? Capital minus drawings plus the profit for the year. And the equity is 810,137. Then we got a non-current liability. They said this didn't change. It was 674,980. And now you've got your current liabilities. Interesting, bank had a credit balance. So we're in overdraft. Look out for that. Bank is under current liabilities and not current assets because it had a credit balance. So there's bank, accounts payable. Now we did these two overnight accounts, income received in advance and accrued expense. They're both current liabilities from the adjustments. And if you add equity and liabilities together, you're going to get 1,840,392. So in this question, you were given the pre-adjusted trial balance. Typical exam question. Given the pre-adjusted trial balance, you're given additional information and you're asked to draw up the statements. The statement of comprehensive income, income statement, and the statement of financial position. You will get a full statement of financial position and a statement of comprehensive income. You need to know the format. If you think about it, it's quite easy, because what goes into the statement of comprehensive income, it's your income less expenses, and the statement of financial position, assets equals owner's equity plus liabilities, your accounting equation. In your own time, you will need to go through this in a bit more detail if you want to go through it, but video 42A covers this type of question, and you can have a look at this as well. All the best in your preparation. I'm going to try and do question 3 and 4 very soon, so look out for that. Cheers everyone, good luck.